Imagine being among the financial elite, receiving a private intelligence brief this morning that guarantees what the stock market will do for the next 18 months. In the third quarter of 2025, something unprecedented happened in global markets that almost nobody noticed. Chinese billionaires quietly moved $47 billion out of US stocks. Not into Chinese stocks, not into Europe, but straight into physical gold. You might think, portfolio rebalancing. But here's what should terrify every American investor holding stocks in their 401k. This is the exact same pattern we saw in 2007, the last time Chinese elites fled US assets at this scale. The S&P 500 fell 57%. Lehman Brothers collapsed. Americans lost $8 trillion in wealth. What if you could sell your stocks before the crash and buy the asset guaranteed to outperform during the collapse? Let me show you the evidence. In Q3 2025, Chinese investors sold a net $47.2 billion in US equities, the largest quarterly sell-off since 1998. But here's the crucial point. $47.2 billion went almost dollar for dollar into physical gold, coins, and private vault storage. This isn't retail panic. This is Ponima Jack Ma and other sophisticated billionaires running, not walking, out of American stocks. To understand the Panet rule. Q3 2024 they were buyers plus 3 billion. Q3 2025 they are net 7 billion. That's a $70 billion swing in sentiment. Chinese investors have been accumulating US assets for 40 years. This reversal marks the first sustained exodus in 4 decades. When the smart money suddenly runs for the exits, that's not a trading opportunity. That's a 5-alarm fire. How did Chinese investors know to sell US assets 12 to 18 months before the 2008 crash? Let's go back to 2007. The S&P 500 hit an all-time high. Everything looked perfect. Except Chinese investors were quietly selling $31 billion in US equities. The timeline is chilling. Selling began in Q4 2006. By October 2007, the S&P 500 peaked. By March 2009, the S&P 500 bottomed, down 57%. From the start of the selling to the bottom of the crash, 28 months. The answer to the question is simple: information asymmetry. Chinese billionaires have 3 advantages we don't. Manufacturing data. They own the factories. When Walmart cuts orders for Christmas 2007, they know 6 months before it hits US retail data. Banking relationships. They saw the deteriorating subprime loan quality firsthand in 2006. Knowing the AA ratings were fraudulent. Government intelligence. Their intelligence apparatus saw the housing bubble bursting in real-time data, not lagging US indicators. When they sold in 2006, they weren't guessing. They knew. If they knew in 2007, what systemic risk do they see now that you are missing? Look at 2025. They are selling more now, adjusted for inflation, than they did before the worst financial crisis since the Great Depression. If the pattern holds, American investors have 12 to 18 months before a major market collapse, placing us in Q1 to Q3 to 2026. Why are they selling now? They see 4 systemic risks. The AI bubble bursting. They manufacture the servers and chips. Chinese manufacturers are seeing Q3 2025 orders for AI chips fall 22%. They see demand changes 6 to 9 months before they show up in Nvidia or Microsoft earnings. They are selling because the AI revenue growth story is about to break. US debt crisis. They've studied every sovereign debt collapse. US debt to GDP is 130% and accelerating. They see the US government on the same path as every crisis they studied. Asset seizure risk. Since 2022, the US froze Russian assets and sanctioned Chinese firms. Chinese billionaires are thinking, if they can freeze Russian assets overnight, they can freeze ours. Dollar decline. They see the dollar's share of global reserves falling to 58%, and the BRICS nations actively working on a reserve alternative. What is the one? Also, the US government cannot, no se okan misma naje and no bank can print more. They are choosing gold for three specific reasons. No counterparty risk. Gold is pure metal. No government can print more of it. No stock market crash can erase it. Global acceptance. Physical gold stored in Singapore or Switzerland is portable, liquid, and beyond the reach of US asset seizures. Inflation hedge. Gold preserved purchasing power across the Weimar Republic, Zimbabwe, and Venezuela collapses. Gold protects against the dollar devaluation they see coming. During the 2008 crash, the S&P 500 fell 57%. Gold was flat, then rallied 106% over the next 2 years. Gold preserved capital while stocks took years to recover. Are you going to be the one selling low and buying high, or the one positioned to buy the bottom? Capital flight happens in 3 waves. Wave 1, the smart money now, Q1 to 026, billionaires and family offices quietly selling. Scale, $50 to $100 billion. This is happening right now. Wave 2, the institutions Q to Q3 2026. Hedge funds and pension funds are forced to sell as the crash begins. Scale, $500 billion to $1 trillion. This creates the crash. Wave 3, the retail panic Q4. 2026 Q1 2027 or 401 holders panic selling at the bottom. Scale, $2 to $3 trillion. By then, it's too late. The smart money is already positioned. Warren Buffett is sitting on cash. Michael Burry has puts. You have 3 to 6 months to reposition, not 3 to 6 years. If you act now during wave 1, you sell stocks at current prices. You buy gold at $2,650 before it runs to $3,500 plus. Imagine having the dry powder ready to buy quality stocks at 50% off in 2027. Here is the action plan based on the smart money's moves. Assess exposure. Reduce US equity allocation to 30 to 40% maximum. Build gold position. Target 15 to 25% of your portfolio. Split it. Physical gold, ETFs for safety, a small percentage in miners for leverage. Reduce hype. Sell or eliminate overvalued tech like AI-only stocks. Increase cash. Target 20 to 30% dry powder for the bottom. If you wait until wave 2 or 3, you'll be the one selling low and buying high. The choice is yours. The pattern is always the same. Brilliant investors recognize unsustainable conditions, get ignored by the crowd, then get proven right. Chinese billionaires weren't wrong in 2007. They're not wrong now. You have a choice. Will you listen to the warning, or will you be another retail investor who learns too late that when the smart money runs, you should too? If you found this video informational, hit the subscribe button right now.